You're watching the price drop and everyone's telling you it's a bargain, but something doesn't add up. The screen says one thing, your local dealer says another, and overnight, silver just took a hit that has people asking questions no one wants to answer out loud. What if the real story isn't what happened to the price, but what's happening to the metal itself? And look, I've been tracking commodities long enough to know when something smells wrong. And right now, in early February, what just happened to silver doesn't pass the common sense test. We're talking about a double-digit percentage drop in a single session, the kind of move that makes your stomach turn if you're holding positions. Gold barely flinched by comparison, just a couple percent down, hovering near $5,000 an ounce. That gap alone pushed the gold to silver ratio back into the 60s, which tells you silver got singled out. And here's the part that should make you uncomfortable. This wasn't some slow drift lower during regular market hours with normal volume and normal participants. This was an overnight shove, the kind that happens when liquidity is thin and someone with serious size decides to make a statement. Whether that statement was intentional manipulation or just market mechanics gone wild, that's the question everyone's dancing around. And I'm not here to sell you conspiracy theories or tell you everything's fine. I'm here to walk through what actually happened, what the data shows, what the physical market is doing, and why policy conversations happening right now in Washington might matter more to your wallet than any chart pattern. If you value this kind of straight analysis without the drama, without the clickbait, without someone trying to sell you something every 30 seconds, then subscribe to Element Axis right now. Seriously, hit that button. It helps us keep digging into the stories that matter, and honestly, it keeps the copycats at bay who just regurgitate headlines without doing the work. And drop a comment too, even if it's just the date you're watching from. I want to know who's paying attention and where you're watching from, because these videos reach people in ways that always surprise me. All right, let's get into what actually went down. The overnight move wasn't just a dip, it was violent. Silver dropped into the high 20s per ounce, getting absolutely hammered while most people in the United States were asleep. And the way it's being described by people who trade these markets professionally is that this started in Shanghai, in the futures market, where one or more large institutional traders allegedly started shorting aggressively. Now, if you're not familiar with how this works, shorting means you're betting the price goes down. You borrow contracts, sell them, and hope to buy them back cheaper later. And if you do it with enough size, with enough capital behind you, you can push through support levels where other traders have stop losses sitting like tripwires waiting to detonate. Once those stops get hit, the selling feeds on itself. It cascades. One sale triggers another, which triggers another, and what looks like a coordinated attack from the outside might just be one massive player throwing a punch, and everyone else scrambling to protect themselves from getting knocked out. That's how modern markets work. They're interconnected, leveraged, and when someone sneezes with enough force, everyone catches a cold. But here's where the story takes a turn that should make you sit up and pay attention. According to multiple sources who follow these markets closely, the Shanghai Futures Exchange didn't just sit there and watch this unfold like it was normal business. They allegedly flagged around a half a dozen clusters of accounts for abnormal trading behavior and restricted them from opening new positions. Read that again. Restricted them from opening new positions. That's not a slap on the wrist. That's not a polite email reminder. That's the exchange saying, you are done adding fuel to this fire, effective immediately. And that matters because exchanges love volume. They thrive on it. Their entire business model depends on people trading, and they collect fees on every transaction. They don't mind volatility when it's organic, when it's genuine supply and demand at work. But when a venue steps in and restricts accounts, they're essentially admitting that what just happened made their market look unreliable. And if there's one thing exchanges care about more than volume, it's credibility. Because if participants start believing the market is being pushed around by a handful of whales, liquidity dries up, bid-ask spreads widen, volatility spikes even higher, and the whole system becomes fragile. Now, I'm going to give you the alternative view because I'm not here to push one narrative. It's entirely possible this was just a liquidation spiral that got out of hand. Maybe someone was over-leveraged and their broker forced them to close positions. Maybe a hedge fund had a risk limit breach and had to unwind fast. Maybe it was poor execution on a legitimate hedge. Big institutional players can be spectacularly wrong without being evil. That happens every day in markets. But here's what makes this specific incident harder to dismiss as just bad luck. The exchange reportedly invoked a specific rule, Article 16 of their abnormal trading behavior measures. If that's accurate, and multiple sources are saying it is, then the venue believed this behavior crossed a regulatory line. It wasn't just volatility, it was conduct they deemed problematic enough to act on in real time. Will that prevent it from happening again next week or next month? Maybe, maybe not. Markets have notoriously short memories, and people with billions of dollars tend to find creative new ways to express their views. But let's step away from the futures market drama for a minute and talk about what you actually care about if you're someone trying to protect wealth or build a position in physical metals. Because this is where the story stops being an abstract discussion about leverage and counterparty risk and turns into a boots-on-the-ground supply chain reality. And this is the part that's genuinely driving people insane right now. The screen price drops overnight, making silver look cheaper on paper, but the physical premium you have to pay to actually walk out the door with metal in your hand is going up. That is not supposed to happen in an efficient, functioning market. But it happens constantly in the real world when supply chains are stressed, when distribution networks are jammed, or when demand is outpacing what the system can deliver in real time. Let's start in Australia. One well-known bullion dealer down there reportedly paused retail silver sales entirely. Not delayed, paused. Their explanation? Global shortage. Now, is that because they literally have zero inventory, or because they're waiting for pricing to stabilize before they commit to filling orders? We don't know the internal reasoning, but either way, the result for you as a buyer is identical. You cannot click add to cart. The transaction doesn't happen. Another major mint in Australia is said to be out of essentially every silver product they normally carry. We don't have their full inventory breakdown in front of us, so I can't tell you it's literally every single SKU, but the broad claim is clear. Retail scarcity is real. And that raises a question that should bother anyone trying to make sense of this market. What exactly is a lower price worth if you can't actually acquire the asset at that price? If you've lived through any kind of shortage, whether it was during a crisis, a supply chain breakdown, or even something as mundane as a product recall, you know how this works. The official sticker price says one thing, the shelf availability says something completely different, and the premium, that extra cost above spot, becomes the reality tax you pay for access. Now let's swing over to Dubai. The Middle East has always been a major physical market for precious metals, and the reports coming out of there are consistent. Silver is getting hard to source. Bars are frequently unavailable, and when they do show up, they don't sit around long. Buyers are reportedly paying premiums in the mid-teens, sometimes higher, above the spot price just to lock in metal. That's not a modest markup. That's a, this is literally the only way I can get this right now markup. And premiums in markets like Dubai function as a real-time thermometer for physical supply. And demand, completely divorced from what a futures contract trading at 3 a.m. in Shanghai is telling you. If you're finding this breakdown useful, hit the like button and share this with someone who needs to hear it. Next stop, Singapore. A dealer there that ships internationally is describing the physical silver market as being under serious, sustained stress. Their language is blunt. Silver is near impossible to source right now. The explanation they're giving is that mints are either shut down or operating at reduced capacity. Refineries are backed up with orders they can't fill fast enough, and competitors across the region are running on empty inventory. We don't have a detailed list of which specific mints or which refineries, so I can't verify every claim independently. But the overarching message is unmistakable. The pipeline that turns mined silver into retail products is clogged. And here's the brutal irony that most casual observers completely miss. You can have a falling spot price making headlines while your actual out-the-door cost to acquire physical metal climbs higher. The screen says discount. Your invoice says premium. And that disconnect is the entire story of what's happening in silver right now. Now we get to Switzerland, and this is the most eye-opening anecdote in the entire situation. But it also requires the most caution because it comes from an anonymous source working inside the industry. Anonymous sources can be accurate. They can also be exaggerating or passing along secondhand rumors. So let's label this properly and treat it with the appropriate skepticism. The claim is that someone employed at one of the largest and most reputable bullion dealers in Switzerland reported that their firm currently has zero silver stock. Not low stock, zero. And allegedly, this isn't a one-day blip. This has been the situation for many weeks. They cannot restock through normal channels. The only silver coming into their inventory is from customers selling back previously purchased metal, and that material gets snapped up by new buyers almost immediately. If that account is even halfway accurate, that's not a minor supply hiccup. That's a systemic shortage at one of the most important precious metals hubs in the world, and the same source claims that gold is also constrained, but specifically in smaller denominations. Coins and small bars are unavailable. What remains are larger bars, the kind that cost tens of thousands of dollars and price out the average retail buyer. That pattern is textbook stress. When a market tightens, the small, affordable, accessible forms disappear first, because that's where individual demand concentrates. What's left on the shelf is the inventory that fewer people can afford to acquire. So at this point, you've got an alleged coordinated short attack in the futures market, and you've got on-the-ground scarcity anecdotes from multiple continents. But now we arrive at the third piece of this puzzle, and if it turns out to be real, it fundamentally changes the calculus for anyone holding or considering a position in silver. Policy. The claim here is not that any government official stood at a podium and announced, "We are stockpiling silver effective immediately." That did not happen, at least not in any public forum we're aware of. What we do have is an emerging language around something called critical minerals coordination. This involves discussions between the United States and Mexico, and broader coordination efforts that reportedly include the European Union and Japan. And the interpretation that some experienced market watchers are arriving at is that the phrase critical minerals is functioning as a diplomatic umbrella term that may include silver, even if silver isn't explicitly named in press releases. In other words, there's a theory that the word silver is being deliberately avoided in public statements to prevent market front running, but that behind closed doors, it's absolutely part of the conversation. Is that theory proven? No. But let me explain why it's not crazy to consider it seriously. Mexico is one of the largest sources of mined silver on the planet. That's not speculation, that's a statistical fact. And if you're the United States government trying to secure domestic supply chains for materials deemed strategically important, you don't limit your focus to rare earth elements and lithium. You look at the entire spectrum of inputs that sit inside critical technologies, and silver, for all its lack of glamour, is embedded in an enormous range of applications. Solar panels, electronics, medical devices, electric vehicle components, grid infrastructure. Based on publicly available data about industrial electrification and renewable energy buildouts, demand for highly conductive materials isn't trending downward. It's accelerating. The policy discussion allegedly includes two concepts that make long-term investors pay very close attention. The first is the idea of price floors, some kind of coordinated framework among allied nations to stabilize or support prices for critical minerals. Price floors are not free market mechanisms, they're interventions, and they signal that governments are worried. Low prices will discourage future production and investment at exactly the moment when supply security matters most. If you're talking about price floors, you're admitting you think the market left to its own devices might not deliver the supply you need 5 or 10 years from now. The second concept is stockpiling, the idea that strategic partners would build reserves of critical minerals as a matter of national and economic security. If silver falls into that category, even partially, you're introducing a new class of buyer into the market, a buyer that doesn't care about quarterly earnings, doesn't care about technical chart levels, and doesn't care if the price feels expensive. They care about one thing, making sure the shelf isn't empty when they need it. And that's why this rumor, even as an unconfirmed rumor, matters. Not because it's guaranteed to be true, but because if it gets confirmed 6 months or a year from now, the market won't politely wait for you to adjust your position. It'll move fast. Now, let's challenge this directly, because otherwise, we're just building castles out of speculation. Even if critical minerals coordination is real, and even if stockpiling is part of the agenda, it does not automatically follow that silver is included. It could be entirely focused on other materials, battery metals, rare earths, specialty alloys used in defense applications. The narrative that it is definitely silver is not supported by hard evidence in the documents circulating right now. That's the honest counterpoint, and it matters. Because you don't want to buy a story. You want to buy based on a rational assessment of probabilities. But let's run the thought experiment. If silver is on that list, what would it do to the market? It would tighten the available float. The amount of metal sitting around available for immediate purchase would shrink because a powerful, patient buyer with effectively unlimited resources would be competing with industry and private investors for the same supply. And in an environment where physical premiums are already behaving strangely and dealers are already struggling to restock, that would be pouring gasoline on smoldering embers. If you've stuck with me this far, leave a comment and let me know. Are you seeing this kind of tightness in your area? Have you tried to buy physical recently? What did your local dealer tell you? I'm genuinely curious because the anecdotes I'm collecting suggest this is not isolated to one region. Here's a practical framework for thinking about volatility without turning it into religion or panic. Gold tends to behave like a larger, slower moving ship. It turns gradually. It doesn't whipsaw as violently because the market is deep, the participant base is broad, and flows are diversified across central banks, institutions, and retail. Silver, by contrast, is a speedboat. It can take off fast. It can crash hard. And when futures markets get strange, it can look like a stunt show. So if you're someone who hates volatility, who loses sleep when your positions move 5 or 10% in a session, you probably belong in the slower ship. If you're someone who can tolerate swings, who understands the risk and deliberately chooses it because you believe the long-term setup justifies it, then you might prefer the speedboat. That's not a value judgment. That's matching the tool to your actual temperament and risk tolerance. There's another layer here that doesn't get discussed enough outside of industry circles: industrial demand. Even without any government stockpile, silver sits at the intersection of several massive industrial trends: solar energy deployment, consumer electronics, medical applications, electric vehicle production, grid modernization. There's a constant tug of war between investment demand, which is people like you, and me buying coins and bars, and industrial usage, which is manufacturers locking in supply contracts to keep production lines running. When investment demand spikes, premiums jump. When industrial supply chains tighten, premiums jump. When both happen simultaneously, the retail buyer feels it immediately and painfully. That's why you can have a day where the futures chart looks cheap, where the headline number dropped overnight and financial media says silver is on sale. But when you actually try to check out at a dealer, the price is higher than it was last week. The screen and the street are telling two different stories. Now, one more thing about the Shanghai futures situation. It's easy, and frankly lazy, to think of futures markets as pure casinos where speculators gamble and nothing real happens. But that's not accurate. Futures markets serve critical functions. Hedging for producers and consumers, price discovery that signals where supply and demand are heading, inventory planning for industrial users. When an exchange steps in and restricts accounts from opening new positions, it's not purely punitive. It's about protecting the credibility and stability of the venue itself. Because if participants start believing the market is being manipulated or pushed around by a concentrated group of players, several things happen fast. Liquidity dries up because people pull back. Bid-ask spreads widen because market makers demand more compensation for risk. Volatility increases because price discovery breaks down, and the entire system becomes more fragile. So the very fact that intervention happened, or is being widely reported as having happened, is by itself a meaningful data point. It tells you something abnormal occurred. Let me give you the part that mainstream financial coverage almost always skips because it is uncomfortable and doesn't fit neatly into a 3-minute segment. You can be completely right about the long-term fundamental story and still get absolutely destroyed in the short term. If you buy something volatile, it can go lower tomorrow. It can go lower for a week. It can go lower for a month. It can also rip higher without warning. It can whipsaw in both directions and shake you out right before it moves the way you thought it would. The most honest sentence I can give you is this: I don't know what happens tomorrow. Nobody does. Not me, not the analysts on television, not the people managing billions of dollars. What I do know is how to watch for the signals that matter beyond a single session. I'm watching whether physical premiums stay elevated or start to compress. I'm watching whether dealers continue pausing sales or struggling to restock. I'm watching whether policy language around critical minerals keeps drifting toward concrete action like stockpiling. And I'm watching whether exchanges have to step in again when the futures market gets volatile. Those are the things that matter over weeks and months, not what one candle does overnight. Let me ask you 2 direct questions, and I want real answers in the comments. First, have you personally tried to buy physical silver in the last couple of weeks? And if so, what did you experience? Did premiums go up, stay flat, or come down? Second, do you think this critical minerals coordination talk will eventually name silver explicitly? Or do you think people are reading tea leaves and seeing patterns that aren't there? I am genuinely curious what you're seeing and thinking because the best information often comes from people on the ground, not from headlines. Here's where price could go from here, laid out as clearly as I can without pretending I have a crystal ball. If the overnight futures move was a one-time event and the exchange clampdown actually sticks, you could see the market stabilize and grind sideways or slowly higher as confidence returns. If the pressure in futures was part of a repeating pattern, if this is just the opening act, then you could see repeated whipsaws that chew up traders on both sides. And if physical shortage anecdotes continue spreading and intensifying, you could see the paper price and the street price diverge even further until people start saying the market is broken. It's not always broken. Sometimes it's just stress. Sometimes the system is being asked to do too much too fast, and the cracks show up as premiums, delays, and availability issues. Now, some people have a personal philosophy where they see red and they buy. They prefer holding tangible assets over digital entries, over promises, over counterparty risk. That's a legitimate worldview. It's not a law of nature, and it's not right for everyone, but it's internally consistent if you understand the trade-offs. When you choose physical, you trade liquidity for tangibility. You give up the ability to sell instantly at the click of a button in exchange for holding something no one can delete from a database. When you choose paper instruments, you trade convenience and speed for counterparty exposure. And when you choose to hold volatile assets, you trade comfort and sleep for the potential of asymmetric returns. The right choice depends entirely on your situation, your timeline, your risk tolerance, and your financial goals, not on what a stranger on the internet tells you to do. All right, final thoughts. A lot of people are going to talk about this situation like it's one clean, simple narrative. It was manipulation, full stop, or it was just normal market forces. Nothing to see here. Or silver's completely gone and you'll never find it again. Or governments are about to hoard it all and send the price to the moon. Real life is almost always messier and more nuanced than any of those stories. What we actually have is a bundle of claims and observations. An overnight futures shock in Shanghai with unusually heavy volume. an exchange response that involved restricting accounts and invoking a specific regulatory rule, a growing collection of physical scarcity anecdotes from Australia, Dubai, Singapore, and Switzerland, with premiums rising in multiple regions, and policy language coming out of Washington and allied capitals about coordinating on critical minerals, with explicit mentions of potential stockpiling. That's enough to pay close attention. It's not enough to panic, and it's not enough to bet the farm. So keep your head. Stay rational. Watch the premiums in your area. Watch the policy language as it develops. Watch whether exchange interventions become a pattern. And above all, don't let one scary overnight candle turn you into a bad decision maker. Thanks for watching Element Axis. Let me know in the comments where you think this is headed and what you're seeing in your local market. And if you haven't subscribed yet, do it now. We're just getting started.